Variable consideration. Jonas Consulting enters into a contract to provide cost management consulting services over a 1-year period for $10,000 per month. At the end of the contract, Jonas will either give the customer a $24,000 refund or be entitled to an additional $24,000 depending on the level of cost savings. The company believes there's an 80% chance that it will be entitled to an additional $24,000 and a 20% chance that it'll have to give the refund of $24,000. In addition, Jonas believes it is probable that a significant reversal of any previous recognized revenue will not occur. The contract performance is determined to be satisfied over time. Determine the monthly transaction price that Jonas should use for the recording of the contract and prepare Jonas's journal entry at the end of the first month of the contract using the most likely amount approach. And so that means using the most likely amount approach that we need to assume that we will receive the $24,000. And so that means we need to include that in the $10,000 per month. And so what's our monthly transaction price? Well, over on the side, we can say 24,000 divided by 12 gives us 2,000. And so that means we're going to recognize the 10,000 monthly price plus this 2,000 of the additional 24,000 that we anticipate receiving allocated over the whole year, or 12,000 as a monthly transaction price. And so now that we have that information, we can use that to prepare our January 31st journal entry that they're asking for. And so we're obviously receiving cash. And let's leave a space. We're going to have sales revenue. So let's fill those in first. The monthly transaction is $10,000 per month. So the cash is $10,000. But we just calculated sales revenue of $12,000. So clearly we're missing a $2,000 debit here. And so that account is going to be contract asset. And I'll go ahead and indent this. And so there we have our journal entry. And it would look like this for the remaining months as well. And then in part 2, it's saying what is the objective of determining the transaction price based on the amount of variable consideration. And so in determining the transaction price, the seller is attempting to measure the amount of blank for providing the promised goods or services. And so the options are risk in the contract, loss to be incurred, consideration expected to be received, or gain to be incurred. And so let's read this one more time. In determining the transaction price, the seller is attempting to measure the amount of consideration expected to be received for providing the promised goods or services.